If your time horizon is less than 4 years, you shouldn't buy the equity. Or the fundamentals of the industry are so much better today than they were 12 months ago that you've now got an extraordinary risk-reward opportunity. Now's a much better time to invest. Nothing great has ever been created by a short seller. We expect Bitcoin to appreciate about 30% a year for the next 20 years. Bitcoin has no employees, it's got no corporate headquarters. It is an index reflecting the digital economy or the global digital economy. Yeah, there's no doubt in my mind Bitcoin will be a larger asset class than gold by the year 2035.
In today's video, Michael Saylor breaks down the new financial landscape forming around Bitcoin and why investors now have more ways than ever to ride the digital capital wave. He explains MicroStrategy's strategy, the rise of digital credit, and how instruments like STRC and STRK offer everything from amplified returns to low volatility yield. Saylor also unpacks the surge in ETF flows, improved regulation, and why he believes this is one of the best risk-reward moments in Bitcoin's history. We touch on the government shutdown, the accelerating AI economy, and Saylor's bold prediction that Bitcoin will overtake gold's market cap by 2035. And don't forget to join our Telegram group for exclusive Bitcoin insights and daily market updates. Let's get into it.
Michael, so good to see you right off the jump here. Look, we had Bitcoin hit a record high just a few weeks ago, $126,000. We've seen this pullback here over the past few weeks. I look at strategy stock down about 27% over the past month. Are investors losing faith in the Bitcoin movement?
No, I don't think they're losing faith. If you're an investor, it really comes down to what your time horizon is and how much volatility can you stomach. So if you want max performance, you're going to take max volatility. Strategy's up 75% a year on average for the last 5 years. So you can actually outperform Bitcoin if you buy an equity that's amplified like MSTR. If you don't want to trust anybody, you want no counterparty risk, you buy Bitcoin. Bitcoin's up 50% a year over 5 years. No counterparty risk. It's very straightforward. If you want to have your cake and eat it too, you could buy some convertible preferred like STRK. STRK will get the vol. Yeah, the vol on MSTR is like 60, 70. The vol on Bitcoin is 45. STRK would get your vol to like high 20s. And you get a mixture of a dividend and principal protection and some of the upside of the common equity. And if your time horizon is less than 4 years and you don't have much volatility to stomach, you shouldn't buy the equity or the equity hybrids. You should buy the credit, something like STRC. You know, STRC is meant to be very, very stable, around $100 plus or minus a few pennies. And you get like a 10.5% dividend, you know, that's tax deferred, and you're getting the benefit of the crypto economy, but you're not on the volatility roller coaster. So everybody's got different risk tolerance. They've all got different pools of capital. The good news this year is now you've got a variety of different instruments you can use to ride the digital wave.
Michael, and as we've gotten more instruments to ride the digital wave, particularly as people have had more and more ways to directly invest in Bitcoin, strategy stock has not done as well. To your point, it has over the past several years. But again, if you're talking about getting in now, or if you got in earlier this year, you wrote it down even as Bitcoin was going up. Are you concerned at all that the crypto treasury, the digital asset treasury strategy that you pioneered is losing a little bit of steam?
You know, over the last year, there's been 100 companies that have added Bitcoin to their balance sheet. The derivatives market and IBIT has surged. The flows into the ETFs have surged. All the major banks have announced support. The accounting has dramatically improved. The tax regime has improved. The administration support at the SEC, the CFTC, the Treasury level has improved. And so, and the technology has improved. You know, companies like Block have rolled out support for Bitcoin on Square and Cash App. So all the fundamentals are good. If you're going to be an equity investor, you have to think for yourself, and you have to have a time horizon of 4 years or longer. And equity markets are either going to lead or lag, and occasionally they'll perfectly reflect reality, but generally it's only a few days a year when they'll be perfectly rational. So if you don't have that 4-year time horizon, and if you don't want to make decisions based on fundamentals, if you simply want to park your money in a stable instrument and pick up a stable yield, you should be a credit investor. You shouldn't be an equity investor. I think the irony is the fundamentals of the industry are so much better today than they were 12 months ago that you've now got an extraordinary risk-reward opportunity. Now is a much better time to invest. You know all the things that you wanted to happen have happened. The market sentiment is negative, but that's an opportunity for the equity investor that makes their own decisions.
Michael, you're seen as a pioneer in this industry, charting new territory in cryptos and Bitcoin. What do you think about the likes of a Jim Chanos and others like him that are trying to profit off of you not doing so well?
I don't really think about Jim Chanos. I think that there'll be some skeptics. They don't really appreciate what Bitcoin is doing. They don't understand digital capital. They don't understand digital credit. But at the end of the day, the big dynamic in the industry is digital capital has gone from nothing to $2.5 trillion over 15 years. Digital credit didn't exist 12 months ago. We've issued nearly $8 billion of digital credit. Digital credit has got a tax equivalent yield of 4 times higher than bank credit. You can have a bank account, in New York City that pays you 4% and it's taxable, or you could buy something like STRC that pays you 10.5% that's tax deferred. So the market's evolving, and the short sellers aren't really interested in the impact of AI or the impact on digital assets to change the way the world works. They're just interested in being skeptical as a business. I don't really focus on them. Nothing great has ever been created by a short seller.
The message is simple. Real wealth is built by people who create value, not by those who bet against it. Negativity and short-term fear might win occasionally, but long-term growth always rewards builders, innovators, and patient investors. If you focus on fundamentals, resilience, and ownership, rather than doom narratives, you position yourself on the side of progress, where the biggest wins actually come from.
Well, I think the money market industry is massive. There's $30 trillion worth of assets invested in treasury-type instruments in the United States. Stretches about 1% of 1% of that industry. It's about a $3 billion issuance. And the big idea here is you take an asset appreciating 50% a year with a volatility in the mid-40s, and you strip the volatility from 45 down to below 5, maybe to 2, 3, or 4, or even 1, and then you extract about 10% dividend yield. And if you do that, you end up with something which is yielding 6% more than the risk-free rate. And when the vol gets to 1, you've got a Sharpe ratio of 6. So we're really engaging in financial engineering to distill pure currency yield above the risk-free rate. And of course, the common stock shareholders in MSTR get the difference between the 10% that we pay and the 50% that Bitcoin's been performing. Long term, the math is pretty simple. We expect Bitcoin to appreciate about 30% a year for the next 20 years. We expect to pay about 10% dividend yield on the preferreds. 2/3 of the benefit go to the common equity shareholders, and most of the volatility is stomached by the common equity shareholders and the corporation. And the credit investors get this pure 10% return of capital dividend. That means it's tax deferred. They don't have to pay tax on it until they sell the underlying instrument. And that means that they're able to invest in a credit instrument that pays them a 10% dividend instead of holding a money market that pays them 4% in a taxable coupon.
Michael, of course, we're having this conversation the day after the government shutdown officially has ended. Things have to restart up again, but still record-setting shutdown. What did you think about the length of the shutdown, and do you believe it reinforces your long-term view on Bitcoin and various other cryptos? Because look, at the end of the day, record-setting shutdown, I mean, how can you have trust in the dollar?
Well, we joke there's no tariffs on Bitcoin. Bitcoin has no employees. It's got no corporate headquarters. It is an index reflecting the digital economy or the global digital economy. So if you just like to buy 1/21 millionth of the global free market, then you buy one Bitcoin. As people lose confidence in a currency in Africa or South America or Asia, as they lose confidence in a government, if they think that their favorite company might make a mistake, war, famine, pestilence, fire, flood, uncertainty, acts of God, all of these things are risk factors, and they're all risk factors that Bitcoin doesn't undergo and doesn't experience. So as people get educated, I think they can see the appeal of buying digital capital instead of investing their money in equity capital or real estate capital or fiat capital or corporate credit capital instruments. And so this is all a teaching moment, but I think that every single month that goes by, more and more people start to appreciate the benefit of owning 1/21 millionth of all the money in the world forever.
Do you see Bitcoin catching up to and surpassing gold's market cap by 2035? What say you?
I do. I think we're in we're in the digital gold rush, and 2035 is the 0.99 year. That means that 99% of all the Bitcoin will have been mined in the year 2035. If you want Bitcoin, you need to get it between now and then, because the last 1% of Bitcoin comes out over 100 years. There's no doubt in my mind Bitcoin will be a larger asset class than gold by the year 2035.
And another social viewer wants to know, why should an investor buy strategy stock instead of a Bitcoin or spot ETF?
If you don't want to take any counterparty risk, and if you have a long time horizon, then you should probably buy the Bitcoin because you can take custody and take it anywhere in the world. If you simply want the asset, you want it in a brokerage account, you should buy the ETF like IBIT. It's going to take you 10 seconds to do that. It's easy to borrow against it. If you're a believer and you want amplified exposure to digital capital, and also if you believe in digital credit, like our mission at Strategy is we want to give 1 billion people a bank account that pays them 10% tax deferred. If you think that's a cool idea to give someone in Japan or Europe or Switzerland or New York City a bank account that pays them 10% with no volatility, and if you think that Bitcoin can power that, then you're buying our stock because we're a digital credit factory. And if you want to outperform Bitcoin and you're ready to get on the roller coaster, you should buy the equity. But if your time horizon is less than 4 years, if you need the money back in 4 weeks or 4 months, then you probably want something principal protected. You want low volatility. You should buy a credit instrument. Like STRC is literally designed to get the vol, down. Right now it's 7, whereas Bitcoin's vol is 45 and Strategy's vol is 65. And if you want something that's going to be extremely low vol, you should buy a credit instrument like a treasury credit product like STRC. You'll outperform your money market. You might very well do as good as the S&P index, but you'll be able to buy it and sell it and get your capital back, in a month, in a quarter, in a year, and you don't have to, worry about the roller coaster.
Saylor's closing points reinforce the same theme. Bitcoin and digital capital aren't just speculative assets, they're part of a rapidly maturing financial system. The combination of strong fundamentals, institutional adoption, and innovative instruments like STRC creates a rare risk-reward opportunity. His message is clear. Long-term vision, patience, and understanding the underlying mechanics beat short-term hype or skepticism every time.